Thanks, guys, for joining us. We got a good guest for you guys today. We're going to get started. So basically, the goals of Grid is to build and support each other in our community and our network to do deals together, but also to grow wealth together. So that's growing your database, return on relationships, invest in people, and develop your leadership skills. So it's a really just a community to engage in. So appreciate your engagement, and looking forward to having we have Carlos here, so I co-host. So maybe what we could do is just go around the leaders first, and then the members. Anything new, any good deals that you could share of? We're getting to the end of the year, so any accomplishments, and maybe how you're feeling about the market. Carlos, you want to kick it off about something new and how you're feeling about the market?
Sure. It's been a very good year for our sales team. We did 100 million in sales. Shane and Nick and I are on the same team. This was our 9th straight year doing that. So next year we better do it again. It'd be great to say 10. I would say that most of the great stuff sales-wise that we did was in the first half of the year. It's been a pronounced slowdown in the second half. Maybe before we finish this meeting, I could try to get a feeling from everyone in the room what you think. But I think that there's a possibility that locally in the DMV, that next spring is going to be insane. And I sneak peek into why, and then we can debate it maybe towards the end of this thing. Because I don't understand the slowdown now. It hasn't really happened for a reason that makes any sense to me. I think a lot of people will not have transacted this fall who might have for demographic reasons, births, deaths, promotions, demotions, marriages, divorces, all the things that trigger transactions. And then therefore they're just going to pile up with the people who naturally needed to come out next spring, and then that the market conditions will be very healthy for that to happen, rates and the economy and so forth. And then the last thing I would say is that I'm a buy and hold investor, always have been a buy and hold investor. Nice to see you, Jason. Nothing complicated, not big apartment complexes, although happy to learn more about it and to seek to do it. But just following my old modus operandi in the last year, my wife and I have been buying real estate. Just like, townhouses in DC we can rent to young professionals. And we're sort of getting back out there and becoming more active again now that college tuition seems to be under control. So we think we get that. That's where I'm at.
It's a beautiful house you guys got.
Thank you.
Lee, you want to say a little something?
Yes, good evening, everyone. Lee Johnson. I'm not in DC, I'm over here in Loudoun County, just because the airport is my office and I travel quite a bit. I'm a technologist. I've been in technology since I graduated college in '93. Had a very progressive career, implemented SAP solutions all around the world. I've lived in South Africa for 2 years, and that's where I met my beautiful wife. After we left South Africa, we went to Singapore, and Singapore was a blast, just because Singapore is in the middle of everything in the world. So, jumped off to Thailand, jumped off to Vietnam, jumped off to Malaysia, just to experience different cultures and, different foods is one of the things that I appreciate about having traveled all around the world. So long story short, when we returned back to the United States in 2014, if you've ever lived the expat life, you know that you are on per diem, and I was on per diem for give or take 6 years. So I had a boatload of money, and I decided that I was going to go into the fix and flip business. But fixing and flipping is great when you make less than $150,000, right? When you make more than $150,000, that just becomes income, right? One of the things that I had to learn the hard way was that if you have capital gains and you keep an asset less than 12 months, it's taxed at your ordinary income. Hence the reason why if you have more than $150,000 in earned income, it doesn't make sense. So after doing that and, you know, sending a lot of checks to Uncle Sam, we did our transition. And of course, everybody knows who's in the DC area that, you know, real estate is where it's at if you can hold it for greater than 12 months. So we spent a long time just trying to find multifamily assets. We were going to look in Baltimore. Of course, if you look in DC, you're going to be spending a hefty amount of money. And I would say probably right now, when I look at DC, the number of units that I'm looking for is about, I would say it just starts at about 80 doors. So I'm not investing in DC at all. I'm investing in other areas of the country. I'm about to fly down to Houston, Texas on the 29th because, thank you for sharing that. We're closing on a 460 unit apartment complex in Houston. I'm going to tell you guys a little bit about that opportunity that we have there. But, you know, I progressed from fix and flip. I progressed from buy and hold to fix and flip to wholesaling to multifamily. And now I'm into the syndication arena. And we'll get into that in just a little bit. But my strategy is to find great operators who you can work with, put some money to work with them. And right now I'm on my 21st deal since 2017, and it's worked out very well for me. So happy to be here, happy to share. Thank you.
You're a busy man. That's a lot of transacting, plus getting a job.
Yeah, and a wife and 2 small kids.
Oh, and kids, that's great. Just really curious, where in South Africa did you live?
I lived in Joburg, right in Johannesburg. I was working for Accenture, and we were implementing SAP for the parastatal called Eskom. Basically, Eskom makes electricity for all of Southern Africa for the most part.
Cool.
And where do you find the time?
You make the time. There's 5 freedoms in life, right? And time freedom is one of those freedoms that you have to be pushing for in your life. You know, there's financial freedom, mindset freedom. A lot of people get stuck where they are just because they can't see the vision. Fixed mindset versus growth mindset. So there's a lot that we as human beings can sometimes get distracted by. I would say for me, focus is follow one course until success. And when I get something that works, I keep it. I keep working it.
Looking forward to it, man. That is
Okay,
incredible.
wait, you can't leave us there because I'm
Yeah.
like,
What are those 5 freedoms?
mentioned
I
3.
know, yeah, I wrote that.
Oh, I thought you guys were into that. So there's location freedom, right? Location freedom means that I can work from anywhere in the world and I still make my coin, right? There's time freedom, which means that, you know, I don't have to, you know, trade, you know, time for dollars, right? I can work when I want to work, how I want to work, etc. Then there's vitality, right? Because you have to have, you don't really want to make money and be sick, right? So what is it that you're doing to make sure that you're healthy, etc.? Then there's mindset freedom. And the book that probably everyone has read is Carol Dweck's Mindset, where she talks about a fixed mindset versus a growth mindset. But, you know, when it comes to mindset, people talk about different things, an abundance lifestyle mindset, blah, 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 right? It's just really having a mindset that when you run into an obstacle, how is it that you're going to solve for that problem, get around it, and move on to your next level, right? And of course, there's financial freedom, right? When you have resources and you can do whatever it is that you need to do, you're not making short-term decisions that impact your long-term viability. So those are the 5 freedoms that you know, I worked with my coach and we got to that, and that's what we basically spend an hour or 2 per week just discussing how are we doing towards progressing towards our goals.
Love it. Love it. Sorry to sidetrack you because I know this introduction's stretching out, but can I just ask
Let's do it.
one question? It's not necessarily about real estate at all, but I just I want to test the question on you. Given your focus on the 5 freedoms, do you happen to be a person who another person could complain to? Or are you not good at listening to that? And if they want to complain, they need to go elsewhere?
I would say people can complain to me, but it depends on the mood that I'm in, right? The team that I have and that I've built is that we listen, right? There's a reason why God gave you 2 ears and 1 mouth. And a lot of people, they do more talking than they should do with listening. But it's just that's who I believe I am. You know, some of the times you get too busy and you just need to meditate, right? And decompress from all of the things that's going on. You have social media, you have TV, you have Twitter, you have Instagram, all of these different things that can actually get people out of that box where they're willing to actually help others, right? And I believe that my motto is the more I help others, the more things will return in favor to me, you know? So that, I hope I answered your question, but yeah, I talk to people all day. That's what I do. That's how I make my point.
Very interesting answer. Thank you.
Pleasure.
Thank you for that question, Carlos. Lee, what was the name of the book that you mentioned? Fixed Mindset versus Growth Mindset?
It's called Mindset, and the author is a lady named Carol Dweck, D-W-E-C-K.
Okay, thank you for that.
And I believe the name, you know, it has a subtitle, but the title is Mindset. I think it's like the psychology of success.
Okay, awesome.
Yeah.
I'll send everybody a link.
Thank you.
Thanks, Shano. So we got to go through some legal stuff. So we're, of course, bringing on great guests, and we're going to be talking about great stuff, but we always advise to go to a legal counsel, tax advisor, you know, things of this nature. It is a network, and so we got to say this legal language.
Not dispensing advice here.
Yeah. So the pros of buying apartment complex. So there's a lot of clear indicators, and Lee will get into this. You could increase your wealth faster buying one large building instead of several small homes, right? Or big homes. So there's scalability. You diversify. So scalability to diversify. If one unit goes vacant, then you have the others to uplift your balance sheet or your income statement. You're not relying on one house. You're diversified. You're spread out. You can massively increase. So value add is a huge one by raising rents and doing things the smart way when buying. You know, usually we say bedrooms, condition. You can't change the location or size, but you definitely change the layout and the condition. And then massive tax advantages for buying apartment complexes. I guess Lee could get into that. Challenges of buying: it's harder to diversify your market exposure. So if the rental market goes down, you know, it'll be at a great cost. Operating costs tend to be higher. Cost of the asset is usually more expensive. There is definitely a barrier to entry into this realm, and that's why we're going to talk about passive investors and active investors in apartment complex investing. And there's different loan products out there. So again, another barrier to entry. But the good news is that there are 2 different types. You could be either be Lee or be Lee. You could be a Lee in terms of finding active deals and procuring you know, people to invest with and doing this on your own, or you just find someone, tag along with them and just give them you know, your money for the returns. So I'm going to leave that to Lee as Lee's point. So Lee is going to talk to a little bit about us with syndication and his experience and an opportunity if you guys have money to invest or know people that want to invest.
Yeah, let me take it over from there. One of the things that, as I mentioned, when I got into the business, it was really how much could I buy based on the assets and resources that I had, right? And that works very well when you're doing single families, or if you're doing townhouses and things of that sort. I know a lot of successful people who have built out real estate portfolios just on, you know, buy and hold, buy and hold, buy and hold, buy and hold, right? So I never knock anyone's hustle. If it works for them, it works for them, right? But when I read a book, probably you hit the presentation, Sean. Nick, I think you hit the presentation is gone.
Sorry about
Yeah,
that.
and
So the strategy that you choose to work for you actually works very well. I'm going to just tell you about the strategy that works for me. One of the things that I had to learn, and I had to learn the hard way, is that real estate is a team sport, right? Especially when you start to get into the larger assets, you're not going to take down that asset all on your own. You're going to have to build out a team. And I have a team of professionals who I work with, from everything from financing all the way through to property management. And what I'll do is I'll dissect how I got into this. And one of the things, as you can see, Jade, he basically said, hey, I can tell Lee reads a lot of books because I have books behind me, right? But one of the books that I read, and it was probably about 15 years ago, I read a book by a gentleman named Eugene Vellucci. And Eugene Vellucci has a book called How to Buy and Sell Apartment Buildings. And this was at a time where, you know, I was still early in my career, and I was just figuring out how was I going to make some money. But Eugene actually pointed out the real reasons why you want to do big apartment buildings versus doing individual assets that you acquire. One of the things that he talked about was economies of scale, right? So I'm going to use simple numbers here, but if you have 100 unit apartment complex and one of those units goes vacant, that means that you have 99% occupancy, right? You should still be able to cover your debt service when you have 99 tenants who are paying, whereas you can get that one property back online. And that's one of the real reasons why I like multifamily versus single family, is because I can go from 0 to 100 versus going from 0 to 100 in small increments. If my tenant leaves that property, right, I'm at 0% occupancy until I find a new tenant, and I got to turn that unit and I get it back up to 100%, right? So that's one reason. The second reason why I like multifamily or commercial is something called forced depreciation against market appreciation. And all of this is something that I had to learn the hard way. Is I had a condo that I was updating in Arlington, Virginia, 4,600 4 mile square or something like that is where the asset was. And I wanted to make that property beautiful, so I went with the extra granite and I went with the extra stainless steel. But I had a problem trying to get a premium for that asset because there were other units within that complex that just wouldn't allow for me to get to that number that I wanted to get to, and I had to bring it down. So that's called market appreciation. You will basically be able to sell a condo or a townhouse or a single family house based on what the market is saying that asset should trade for, right? However, when it comes to multifamily, in particular value add multifamily, I can increase the value of that asset, right, by going in and increasing the net operating income, right? So the net operating income is going to be very crucial when you're investing in multifamily units at a larger level, right? Because I can go in there, I can make the same renovations that I did for single units, but I'm doing it at scale. And then when I'm doing that, I'm turning properties, and when I put them back online, I'm charging a higher rent, right? So I can force the appreciation on that asset. But there are other opportunities that I have found in the multifamily space. I can bring amenities, right, to the asset. You guys live in the city, valet trash, you pay for that, right? Basically, you put your trash can in the hallway, somebody will come and pick it up for you. That costs money, right? Reserve parking. Have you ever heard of that? That's also more money. And because I'm dealing with workforce housing, people will pay me to have a washer and dryer in the unit, having to go to the laundromat. These are all different opportunities that I have to increase my net operating income. But at the same time, the second is how can I reduce my expenses? So when you're working in the multifamily space, it's called RUBS. And RUB stands for ratio utility billing system. It's basically where I now, as the property owner, I can charge my tenants for water and sewage that they consume, or I can give a package where I'm offering internet and Wi-Fi and internet and television packages just the same. All of these are increasing the net operating income. And when you multiply the net operating income by the cap rate, you get a purchase price. So in a small time frame, right, 2 years, I'm going to give you an example. And if you go to my website, you'll see the asset that we're about to sell. We were able to purchase an asset in 2019 for $51.5 million, right? It's called Carrington Braxton, and it's in Raleigh, North Carolina. Right now, that property is going to sell on November 24th for $79.9 million in less than 2 years. So we're going to be able to exit that opportunity with nearly a 1.9 equity multiple on your money. So within 2 years, you've been able to double your money. But why multifamily also works for me is because we've been receiving cash flow distributions ever since the first month after the closing. So while I'm invested, I'm also receiving cash flows at the same time. So back to the point, what is a syndication? A syndication in layman's term is a group investment where you have a bunch of people who come together and they say, well, I'm going to purchase an asset. When that group investment comes together, there's the general partners who are the people who put together the deal, right? They have to put together the risk capital, they have to do the due diligence, they have to put together the financing, they have to find the property manager, and they're also going to be responsible for something called asset management while the business plan is executing. Those are the guys who have to do all of the hard work, right? And this is the business that I'm in.
Lee, sorry to interrupt you.
Go ahead.
Did you see that one of our participants, Jason, just in the chat indicated that he's invested in the 71 to, was it 51 to 79 one you just said?
Yeah.
Through passiveinvesting.com.
Passiveinvesting.com. That was one of my first investments when I was moving into syndications. And, you know, I liquidated almost everything that I had because I was going all in on multifamily investments, right? So this was the first, one of the first syndications that I moved into, right? But it's a great story that tells, because it's Jason, he probably, if he invested with Passive and on that deal, he probably invested in another one. So just recently, there's another deal that they're selling called Willowbrook, right? Willowbrook is going to be selling just the same, as well as they brought out another one, Orchard Parks. That's also going to be selling. All of these things were picked up in probably 2018, 2019 timeframe. So what happened with all of these properties, right? Nearly I'm going to be able to double my money in that time. And now I'm going back in, but I'm going back in at a bigger level, right? So
what was the name of this project again?
There's different projects. One was called Orchard Park, right? Same group, right? The other one is called,
where was Orchard Park?
Orchard Park is in the Carolinas. Okay. All of these are in the Carolinas for the most part, right? So all of those are exiting. And how I built my business was basically by investing in so many of these until I got access to what is called the GP side of the house, right? So you invest in it. And when you're making this investment, right, there is the limited partners. Typically, the minimum investment is going to be $50,000, but you invest in it and you basically have to read something called the private placement memorandum, right? So the private placement memorandum, for all of you lawyers that are out there, is a document that's qualified by an SEC attorney that basically can tell you everything that can go wrong, right? So long story short, there's a couple different ways that you can get into multifamily. Either you can go in on your own, right? And I was talking to Carlos at the very beginning of this. I don't know, he must have stole my story from Nick, because when I spoke to Nick, Nick asked me an interesting question that if I had to do it all over again, how would I do it? And I told him I would buy me a fourplex, I would live in one unit, and I would rent out all of the others. If I had to do it all over again, because guess what? Anything with more than one unit is technically multifamily, right? Anything up to from 1 unit to 4 unit, you can get with residential financing. It's only when you go to 5 and above do you have to go commercial, right? So there's different ways that you can do it. But for me, right, the real reason why I'm invested in real estate is because of the passive income that comes along with that. And there's also something called cost segregation. Because cost segregation, I don't think you're going to do with a single family just because of the cost that it takes. But long story short, cost segregation says an asset that you purchase has a life, real estate asset, physical asset, of 27.5 years. And I can depreciate that over the 27.5 years. But the wonderful thing about the tax code is you can accelerate that depreciation, right? You can do something called the cost segregation and accelerate the schedule, which generates passive, that generates negative K1s, right? Because you're invested in an LLC as a limited partner, right? You're going to get a K1 at the end of the year. If that K1 shows a negative amount, guess what? That means you don't have to pay taxes on the income that you receive from the cash flow distributions that happen at a monthly or quarterly basis. So I'm going to pause right there because I get excited about this.
Can I jump in to translate that?
Huh?
I want to jump into to translate what you
Go
said,
ahead.
the negative K1. I saw, I think Franklin's brow was knitting tighter and tighter, negative K1. So, you know, the K1 is it's the form that shows the partner in a partnership, like say an LLC, the money that he made that year. So I think what Lee's describing, so, you know, instead of a 1099, you know,
Yeah.
like a gig worker or a, what is it, W2 for an employee. So a partnership return is a K1. So imagine you're a partner in this big asset and you're actually making money every month. But because of cost segregation, you've been allowed to compress into fewer years the massive, what was already going to be a pretty big number across 27.5 years, the depreciation deduction number. And fundamentally, you're going to make it look like you were making no profit through basically legal smoke and mirrors, basically.
No,
And so-
it's leveraging the tax code.
Yep.
Right? And another book that I'll give you guys, and it's one of the ones that means so much to me, is Tax-Free Wealth. I got that one from Rob Chavez probably about 4 years ago. And when I read it, it absolutely changed my life. Right? But what Tom Wheelwright, who is the creator for Wealthability, said is the tax code is about 5,800 pages, right? About 100 of the tax code states how the government is going to tax your income, right? The other 5,700 pages is dedicated to teaching you how you can keep more of the money that you make. So you have to ask yourself the question, how is it that Elon Musk can make billions of dollars and be the world's richest person and pay zero in taxes? How is it that, I was talking to a colleague the other day, how is it that Jeff Bezos is the second richest person in the world and he has an Amazon salary of about $82,000 a year? The tax code and the majority of the tax code is there to tell you how you can keep more of your money. And you have to have a tax strategist or a wealth strategist who actually helps you to understand the tax code. Because if you're over here making your coin one way, you don't have time to spend, right, figuring out the tax code. You pay somebody to do that for you, and you go about there making your coin, and you leave them to do what they do best. And you pay them very well, right? To get a tax strategy created, you're probably going to spend between $10,000 and $15,000, right? But if that $10,000 or $15,000 is going to save you $40,000, why wouldn't you do it all day, every day? I hope that makes sense. Makes sense to me.
Absolutely.
All right. So you have a general partner, you have a limited partner. Most of these are structured via LLCs, right? So there can be a carve out where, you know, 70% of the LLC is going to go to the limited partners, the other 30% go to the GPs, right? If you wanted to find out more about that, you know, the best book that you could probably get on that is a book from Gene Tobridge called It's a Whole Different Business, that basically talks about how it is that you're going to raise capital. Because what I have learned in my journey is that really it's a conversation about how it is that you're going to raise capital so that you can actually move into these investments, right? So I was talking to a mentor of mine the other day. He's in Bethesda. He buys technologies companies, right? And basically he's a venture capitalist, right? They basically put money into a fund where they go and buy technology companies, right? And I said, I'm doing the exact same thing. It's just that I'm doing it for real estate and he's doing it for tech. There's a major difference between I can give you let's say a 2x equity multiple in 3 to 5 years, right? With a technology or venture fund, he's probably going to be able to give you 5 to 6 over 10 years, right? So you have your opportunity cost as to where you're going to put that money to work with you. But I guarantee you, right, when he sells an asset, the tax bill is going to be pretty heavy. When I sell an asset, if I do something called a 1031 exchange or swap until you drop, I never have to pay taxes. And then I can leverage the asset with loans, right, where I pay 3, 4, 5% on the asset, and I can live the lifestyle that I want to lead. So it's really not a conversation about how much money you make. It's a conversation about how much money can you keep. And real estate and syndications is one of the vehicles that I use in order to get there. Any questions?
That was great.
That was powerful.
Multiple over
Yeah.
3 to 5 years versus 5 to 6 multiple over 10 years, but much more tax efficient.
Yeah, because there's have you ever heard of tips? And tips is like when you're buying treasuries, but you're constantly rolling. So whenever one comes due, you're buying another one. So you're always getting like a dollar cost average on the money, right? But what I do with my returns that I'm getting from my syndications is I take them and I put them onto a platform called Peer Street. Peer Street is for accredited investors, but I'm now able to do what I did before. I'm making hard money loans, but now it's spread across the first trust position. So when I was doing hard money loans in the Northern Virginia area, right, I would do a friends and family type of loan where I would give $50,000 for the renovation, right? But that would put me into a second trust position. And guess what? Second trust doesn't give you nothing. You basically have nothing, right? But what I'm doing on Pierce Street is I'm actually taking that money and I'm putting it into a first position loan where I'm getting 8, 9. I even once upon a time got an 11% loan on Pierce Street. So what I do is I take the money from the syndication, I move it over to Pierce Street, it builds up again, and then I move it again. And now I'm at the point where the deals that I'm invested in are coming full circle. I'm doubling my money and I'm going back in again. So if you were talking to me 2 years ago, 3 years ago, I couldn't talk to you about a full exit, right? Now I can talk to you about not only one full exit, but I can talk to you about 3, right? And it's a wonderful thing because I don't think people actually love real estate. I know, I'm sorry I had to break some hearts, right? But people don't really love real estate. They love the outcomes that come from real estate, right? If you are more focused on the outcome that comes from real estate, then I just say you have to pick the vehicle that works for you. Remember, I don't knock anyone's hustle, right? If single families work for you, let it work for you. If flipping works for you, let it work for you. If hard money lending works for you, let it work for you. It's just that based upon my situation, right, with a high income, right, doing flips didn't work for me anymore, so I had to move to another direction.
How do you feel about 2 things? The possibility that if the market moves south and the exit isn't there, you may have to hang on to a complex that you had just improved. You brought the costs down, you brought the revenue up. It's performing better, but the exit doesn't, just because of where market appetites are, don't look so great. How do you feel about that? Because that doesn't sound like the end of the world to me.
Yeah.
Yes. Talk a little bit more about how you feel about that and what that will look like if you are ever in one of these and there's a sharp downturn on the resale side.
Carlos, thank you. I love your brain and the way that it works. But you heard of COVID? Right? Literally, I liquidated all my past 401ks and I put all my money into a self-directed IRA. Right? Guess what? Sorry for using the word, but I SHIT a brick when COVID was coming, because guess what? I figured that, okay, if I'm dealing with workforce housing and the workforce can't go to work, they're probably then going to go to that situation where they're no longer paying, right? So I would have an economic vacancy, right? They're there, but they're not paying. I don't know if it's just like a one-time scenario, but all of these assets, and I'm invested in 18, 19 different syndications, right? Every single one of them is still performing today, right? As a matter of fact, they've overperformed, right? And one of the things that I teach is the fact that you have to select different types of assets, right? So the criteria that I use is that there always have to be a preferred return, right? And I typically like 7 or 8% as a preferred return, right? And I love it when they distribute the cash flows on a monthly basis, but a lot deliver cash flows on a quarterly basis, right? When you have that coming to you, right, these assets continue to perform because the government gave a tremendous amount of stimulus. People continue to pay their rents, right? I have a couple of friends or colleagues who had invested in the small multifamily, right? 10 and 20 units. They got burned a little bit because really they didn't have the on-site property managers who had the attorneys, who knew how to go and apply for that PPP, who knew how to work with the legislation and get those monies into their accounts, right? Because if you're a mom and pop, for the most part, you're still having another job, right? So you don't have the time to go and read the legislation and know how to apply for rent relief for your tenants. But when you have a property manager, right, on site all the time, and they are with a regional or a national firm, they have attorneys who then put together the programs. And guess what? This property was purchased in 2019 and now it's selling, right? And it's selling. I got an email that is going to be about 1.84, but I also brought in other capital investors into the deal. So I have a little bit more that's going to be coming to me. But in 2 years, to basically get near to doubling your money, where can you find that? And that might just be a one-time scenario that's there, but it is there. All right. So,
but Carlos, I think what your question was is what is the downside of investing? Is that what you're asking, Carlos?
oh yeah, he said he was asking
how bad is the plan B? Because
No,
I'm already a buy and hold guy, it doesn't sound terrible to me, but
no. If I have a 5-year exit plan, right, and I get to 5 years and I can't exit because the cap rate, the revision cap rate that I have forecast is not there, right? Usually by year 3, once you've done all of the CapEx and the renovations, the asset will now sell for a higher price because you've raised the rents, right? So usually by year 3, you can start courting brokers and others to come and talk to you about purchasing that asset. So between years 3 and 5, you have plenty of opportunity to exit that business plan. And these guys are deciding to exit in year 2, right? So if you can't sell it at that point in time, if it's cash flowing and the rents are coming in, you might have to deal with a little, the terms of your loan, right? Because the first 3 years, first 24 months, 36 months of these deals are typically interest only, and you might have to start paying interest and principal, but you could also refinance it, pull out the capital, right? And then let that thing still cash flow on and on and on and on. Right? So
Talking about financing, who are the players, or who should you know? So you have, who would be financing these deals? Is it like big banks, and they do it based on the balance sheet, the acquisition, or do they do it based on the future value, future rents, a little bit of both?
a little bit of both. They're going to look at, right? So there's 4 different wings that you have, right? So there's core plus, there's value add, and there's opportunistic, right? Opportunistic is a place that I don't play so much, but it offers a higher IRR. And that's where you have shovel ready projects. But that starts with dirt, right? You have to build the structure. And then once you build the structure, you have to lease it up, right? So typically, you're not going to get any cash flows for 3 to 5 years with that type of development, especially if you're early in the permitting process, blah, 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 right? And then there's core. So core is an asset that's new and it's been built up. The developer probably has leased it up to a certain level where you can put debt on the structure, right? But that's a new asset. Those new assets don't have any deferred maintenance. So you don't really have to have huge renovation budgets, et cetera. You just got to keep it going. And after that property is about 10 or 15, 20 years old, it moves into core, right? Core means that, hey, it's a little dated now, but I still can put money into it to make it a little bit better. The one that I like the most is value add, where the property has a tremendous amount of deferred maintenance, because remember, I'm a flipper, right? Has a tremendous amount of deferred maintenance, right? And you can come in, put money into the asset. So this asset that we're doing in Houston, we're putting $4.4 million into it, right? After the previous owner already put in about $2 million, right? So there's a lot of work that has to be done, but guess what? We can increase the rents by about 30 to 40% over this hold. And we are forecasting that we'll be able to sell this puppy for about $60 million in 5 years.
And
So-
how much did you buy it for? And how much do you guys have to put down? And then where did you guys get the money for the down payment?
So the asset is being purchased for $40.1 million, and we are raising $10 million in capital. That's going to include both the equity portion for the down payment as well as the renovation budget, just the same, right? So how we started this conversation was talking about, well, what kind of capital stack are you going to put on it, right? And depending on the asset, what's the occupancy, you always want to try and get agency debt being one of the mains, right? Fannie Mae, Freddie Mac, etc., because they have very reasonable terms. If you can get agency debt and sign on a loan for it, you are almost in a golden position. But sometimes you might have to go with, bridge loans just because the occupancies aren't at the levels that you need, right? Sometimes you might have to do some mezzanine debt, just the different things. But what I would say is that, you find you a commercial broker who actually talks that talk and understands the different products that they can bring to the table to make the business plan work, right? Because at the end of the day, you're always looking out for those LP investors to make sure that they can get their money back, right? So all of it has to work. The business plan, the debt structure that you're going to put on it, all of it has to work so that you can meet that obligation that you have to your LP investors. And one of the things that I mentioned is that I always, I'm an investor first. So before I got access to the GP side of the house, I was always an investor. So I started out with all of the syndications that I invested in, built up my track record, built up my knowledge, right? And I always have to have a preferred return. If there's no preferred return, I walk away from a deal. I had a guy who was telling me that, oh, this is going to be a sweet deal, right? We're offering 80-20 on the back end when we sell it, but there's no preferred return. So I'm saying during the hold, the GP team can get paid, but the LP, there's no real reason why they get paid. They get paid when the property is sold. That doesn't work for me as an investor first. I have to have my preferred return.
Can you just take it from the top and
Yeah.
systems,
Capital.
just break down what a preferred return actually is? You
So
said it, you implied it, but just start all over.
A preferred return says how much annual yield you're going to have on the money that you've invested. So if you invest $100,000 and you have an 8% preferred return, that means that the LP investors will receive $8,000 before the cash flow distribution split kicks in. Does that make sense? So with the preferred return, the LP investors get paid first before the sponsor team gets paid. The sponsor team will then have a split above that 8%, and it could range anywhere from 60-40 all the way to 80-20, depending upon the structure of the deal. So the last deal that we did in July, we had a 65-35 split, right? We offered a 7.5% preferred return on that one, right? On this deal, it's a little bit better of a deal, right? We're offering an 8% preferred return, and we have a 70-30 equity split, right? Above that. So every single deal is different, but what I do is I talk to people about, hey, as an investor first, this is how I invest in these different deals. All right, so player scalability.
Capital stack. Oh, and then John has a question. Are your preferred returns monthly?
I would say yes. So one of the things with Jason, you've invested with passive, you know that they give monthly distributions, right? During the COVID times, they continue to pay monthly, but others went to a quarterly distribution just because they wanted to maintain their cash reserves, right? So that makes a lot of sense. If I can get a preferred return in a monthly cash distribution, I'm taking that all day. But I will fall back for a quarterly, but I don't go to a semi-annual or an annual distribution. That just doesn't work for me. What was the other question, Nick?
You know, it's interestingly, I went to another grid event where a person was buying a 95 unit thing out of Lynchburg. And what they do is they give their investors back their money first, and then they go 50-50 on the profits. So I thought that was very generous. I even told them, I was like, wow, that is very generous. And they're
But
like, we
the
have.
thing is, there's return of capital and there's return on capital, right? So if I do a return of capital, that means that every time I make a cash flow distribution to you, I'm reducing your principal that's inside of the deal. So monthly or quarterly, as I'm paying you, right, the asset is turning over to me, right? That's why you want to invest in a deal that has a return on capital. That way your principal amount stays the same. And when they dispose of the asset, that's when you get paid and your principal is returned to you. So I know John, and he walked me through the deal that they're doing in Fredericksburg.
You mean Lynchburg?
I thought it was Fredericksburg.
No, Lynchburg. It's a deal in Fredericksburg. I would invest in that. That's close by.
But
Lynchburg.
it's really hard. Like for instance, I'm working with an investor over here. He has a deal. I'm not going to say where it is because you guys will probably know it, but he's looking at paying $160,000 for a door, right, for a complex over here. And in Texas, the property that we're purchasing it for just under $88,000 a door. So I get the economies of scale, and the only thing that I had to do was jump on the plane and go to Houston. So there's different opportunity costs that you have by where it is that you're investing in the United States. But you know, all of the deals that I've invested in so far have all been in the southeastern region of the United States. And as Carlos was starting to have that conversation and talk track, is people are leaving high income states. They're leaving New York, they're leaving New Jersey, they're leaving Chicago or Illinois, they're leaving California, and they're moving to places like Texas, Utah, places that don't have a state income tax is where people are moving to. And as you can see from the political landscape, right, New York lost one House of Representatives seat, Texas, I believe, gained 2. Right, and the mass migration into Texas, Dell Technologies is there. Google is building a second quarters there. Apple has built up a huge complex over there. So many of the tech companies, they're saying, hey, let's leave California, which has a high income tax, and they're moving to places like Texas. And Texas is huge. Texas is a huge place. There's El Paso, there's Dallas Fort Worth, there's huge. There's so many different places in Texas, right, that you can move to. Texas doesn't have a state income tax, but they do charge you a lot when it comes to property taxes. So for me, they're going to get you one way or another, but a lot of people are moving to Texas, not only because it has the jobs, but the cost of living is also very low there as well.
What about the Midwest and the Rust Belt states like Pennsylvania, Ohio, and so forth?
The first criteria that I use whenever I'm selecting a place where I want to go and invest, tell me what's the increase in the number of jobs. So when I'm selecting an MSA, which is a metropolitan statistical area, right, I'm always looking to see if there is an increase in jobs, right? A second factor that I look for is there increases in rents, right? Because I'm looking to get in probably during right after a recession. But you know, if you understand the financial cycle versus the real estate cycle, the financial cycle right now is very long. We haven't had a recession since 2009. So the financial cycle is long in its teeth right now, right? But real estate cycles are always local, right? So you can invest. I know people who are investing in Kentucky and Indiana just the same, right? But I always look first for jobs, right? And then I look for the ability to increase rents, because if there are tenants who are moving in there, I want to come in there, take an asset that's not performing at market, renovate it, get those rents up, and I'm looking to exit. And
Is there a correlation between what you just said? Sorry about the dogs. Is there a correlation? Is there a correlation between what you're saying and the risk of vacancy? I definitely heard you say rents, well, jobs lead to rents. What's the rental trend, and can I improve this community to charge that premium to drive the revenue up as I plan to do? I hear that's embedded in your interest in the rents. But is also a factor the risk of vacancy?
Yeah, well, so there's something called alndata.com, right? ALN basically will tell you what's going on from a vacancy or occupancy perspective and a rent perspective at the same time. And they share this data freely, right? If you wanted to get more into the weeds on the data, right, you would have to go to the paid service. But if you go to ALN data, they'll give you the data for Fredericksburg. I can know what Fredericksburg is doing, and I can know whether or not if the rents are increasing faster in Fredericksburg versus Newport News versus Richmond versus Raleigh Durham, right?
What is that site again?
ALN data.
How do you spell that?
ALNDATA.com.
It's like Alpha, Larry, Nancy.
So
ALN data, I got you. Yeah. Okay.
For any MSA, so that you can know whether or not if the rents are trending in the right direction, right? For you to then go and say, well, this is an MSA where I want to invest in.
Because of your criterion around the job market and the rents, at the end of the day, is the bottom line that because I'm Lee and I look for this kind of an opportunity, I don't always necessarily get the best cap rates. That's not exactly what I'm after. What I'm after is these other things. And sometimes I may end up in a market where the cap rate's a little lower, but the risk of vacancy is a little lower, but the opportunity to charge that premium is a little greater. Is that true? Is there a correlation there?
There is a correlation there. What I have found is that it's very difficult to determine what the cap rate is, right? You're really buying the cap rate based on the asset class, right? So like, for instance, a tier 1 city like Washington, D.C., they're going to have the most compressed cap rates of all, right? But if you were to go to South Carolina, and depending upon the asset class that you're looking at, so there's A, B, C, and D, right? So a C-class asset says that, oh, there is deferred maintenance, but it's not in the dump, right? A D-class property in a D-class neighborhood means that I don't want to go there at all, right? So you got your class of your property, and there's A, B, C, and D, and then you have your location. There's A, B, C, and D. So if you can get a C-class asset in a B location, that means that you can come in there, you can reposition the asset, changing the name, etc., letting them know that there's new management, right? Change the name. What we did with the property that we acquired in July, it was called Savon Villas, right? We now renamed it to Addison Oaks after the daughter of one of my partners, right? So we're repositioning that asset so that we can draw new tenants into it. And that's one of the things that you have to do. Remember, I talked about core plus, value add, and then there's opportunistic. And the swim lane that I know right now is value add. So this is the deal that we just put together. Thank you for sharing it. We're going to close on the 29th. That's why I'm going to be flying to Houston after Turkey Day, right? We're projecting, all of this is based on a pro forma, right? And you put your pro forma in front of your financing people as well as in front of your investors, right? So we're talking that we're going to be able to execute a 2.3x multiple. So if you invest $100,000 in this deal in 5 years, you're going to walk away with $230,000 on easy numbers, right? So we're given a preferred return. So on that $100,000, we're going to distribute 8% on an annual basis, but we're doing it on a quarterly basis, right? So we're going to be given $1,000 cash flow distribution every quarter. We just for the deal that we closed out on in Texas City, right? Just today, we sent out our first cash flow distribution, right? And a $50,000 investment in that got you a return of $936.12. How do I know? Because we just hit the ACH button to send out the distributions to all of our investors. So, you know, because this is a multiple year hold, some people like to talk about the annual cash on cash return. That's at 9.2%. But really, when you're talking about multi-assets and multi-year investments, the real lever that you're going to be looking out for is IRR, which stands for internal rate of return, right? And that shows you the time value of money over a certain duration. The properties that Jason is invested in and I'm invested in, that's going to have an IRR that clears 35%, right? Literally. So now,
can I ask you an actual question? If I put 100,000 into this project, 5 years from now, roughly, I might pull out 230, right?
yes,
Okay, after having received some coupons some payments along the way.
I love that. You're a finance guy. You talk in terms of coupons.
And then my question is, for a 1031 purposes, I've got the 230 equity. Do you happen to know what the minimum, if I just wanted to take it and go buy a 2-unit somewhere, what the value must be of that 2-unit?
You're not going to be able to do a 1031 out of it, because in order to do a 1031, the same entity that's selling the asset has to be purchasing the asset.
Got it.
Right? So Jason is there. With passive investing, they're also giving us a 1031 option because they're going to go and purchase another asset. So if we wanted to keep our money invested, we can just have it roll over. And that means that we don't have to pay any taxes, right? You also have the other option is to take your money and run. And then what you can have, depending on your situation, is all of those accrued negative K1s, right? You probably will have some tax consequence there, but because of your tax situation, you might not have to actually pay any money at this point in time.
So even as a passive investor, I'd file a K1, not report the cash flow as income.
Well, the thing is, and this is another one, cash flow quadrant, where Robert Kiyosaki, it talks about the different types of income, right? So you could only have passive losses against passive income unless you are, like yourself, a real estate professional who also has material participation, right? So you can then take that against in current year. But if you aren't qualified as a real estate professional and you don't have material participation, those negative K1s, they accrue, right? So that's the good piece of it, right? Because they accrue when the asset is disposed of, right? There's going to be something called depreciation recapture, right? Hopefully it all balances out so that you don't have to pay any taxes. But one of the things that you said in the disclaimer was that, hey, I know how this stuff works, but I'm not your accountant. So you would have to go and talk to your financial professional and your tax advisor so that they can structure your situation with LLCs and trust and things of that sort, so that they're minimizing your tax obligation. And that's why I say, when you go and work with a tax and wealth strategist, that person will help you to put together the structures so that you minimize your tax consequences, but they have to understand how you're going to be invested in everything like that.
And one of the things you did say at the beginning of your answer was that if the same entity goes on to do another deal and you keep your money with the entity, that's how you could roll it up.
Well, that is one of the advantages of if you are probably in the DC area and you're able to buy an asset, because you're going to hold that asset in an LLC, right? And then when you sell that asset,
I'm asking is in the one you just advertised, if I put 100,000 in with you, so now I'm a limited partner, right?
you're a limited partner.
Yeah. So and 5 years from now, you're ready to give me back 230. I could say, well, can we push it into the next deal?
You could say, can we push it into the next deal?
And then if you had enough limited partners who wanted to do that, maybe you'd keep that entity going so that it could go do that.
Yeah,
Uh-huh.
that's the option, because Dan and all of his team are probably invested as well, and they don't want to have that huge tax consequence, right? So they're saying, and they're carving out a section of the LLC for 1031s,
Oh, they are.
right? Yeah, so when you read the PPM, you'll see something inside of the PPM that talks about a tenants in common, right? And the tenants in common is what's going to be rolling over and purchasing equity in the new deal.
You just mentioned a person, Dan?
Dan Hanford. Dan Hanford is one of the owners of passiveinvesting.com.
Oh, I see. Got it.
Mm-hmm.
Got it. But the Valencia Apartments is your project.
Yeah, that's my deal.
Yeah, it's your deal. Okay. And where is this again? Oh, okay, Houston.
Houston, Texas.
It's good looking.
No, because the current owners, this had a brown facade on it. Now it's blue, right? So they've already put about $2 million into it. We're going to put another $4 million into it and turn it all around. Because when you do a transformation on the property, you're not only transforming the asset, you're transforming the community, right? So they've already started some of the renovations, so we don't have to do all of the renovations for everything. We just really have to make this, it's a class B right now, but it's probably a class B minus, right? And if we can go in and add additional amenities and make it a real comfortable place to live, right? We believe that we're going to be able to get those rents up to where the market is for Houston right now, right? And then we'll be able to walk away from this asset in 5 years. We're probably going to be able to walk away earlier, but that's the plan.
This is the way it looks as it now exists?
That's one unit. That's one unit. Remember the current owners, they started some renovations, but they weren't prepared for COVID.
Got it.
And they got into trouble.
So you're going
That's why
to, in part, you're going to continue the execution of their vision that they just couldn't carry out.
Oh yeah, but that's where the business plan is proven, right? Because the business plan is proven, right? We have less risk going into this because we know where Houston and the rent markets are, that we will be able to get a certain amount, right? By continuing the renovations, changing out the property manager, etc.
And so you're going to buy it at what per door, roughly?
About it's 87, but I would go with $88,000 a door.
And what do you think the current rents are per door, roughly?
Not per door, but you see here, we're purchasing at 95 cents a square foot, and we believe that in-place rents, we can take it up to about $1.18 per square foot. So that's about a 30% premium.
Mm-hmm.
Now, the second piece of this is we're going in with, a national property management company. They have 100,000 doors under their belt, right? So all of those efficiencies that they have across those 100,000 doors, right? We're going to be able to leverage that, right? And they already are running the asset that we purchased in July. And they took occupancy up from the high 60s, and now they're close to 83% occupancy in 3 months. So we were forecasting that they might be able to get it up to 90s, but the units that are offline need more than a light turn. They need a heavy renovation. So that's the reason why we are in the high 90s going into December.
That's the reason I can think of, right? At least it's not the market. You just need to get,
Yeah, but with the other property, we also, there's supply chain issues. We have to purchase 40 refrigerators, right? And the supply chain is a little bit of a challenge. Also, you have challenges with, construction materials and things of that sort, right? But, on the asset where we have right now, Houston is always hot. So we're buying 100, 200 HVAC units, right? The group who I'm invested with in Houston, we own 4 assets there already. So we're now getting the economies of scale from working with the same property managers and, rinse and repeat. So we forecast when we underwrote this that we would be charged 3.5% on our property management fee. We actually got it for 2.5 because of the synergies that we have with the other asset. So that's hundreds of thousands of dollars in savings.
Yeah, interesting.
Yeah.
So now you're hunting for deals in Houston for sure.
Well, I'm going to be looking in the Raleigh-Durham. So we're going to expand, right? My business partner, she lives in Houston. She's building an ecosystem out there. I need to continue to build my ecosystem. I'm going to build my ecosystem in the Carolinas, right? So typically you buy a bunch of assets, you surround them with a property management company, you get economies of scale, right? And you rinse and repeat. So that's my strategy. Next year, when if you guys have me back, I'll be telling you about a deal that we took down in Newport News or Raleigh-Durham or something like that.
So just one question, and I can't let go of my buy and hold mentality. So someone who's smart is going to buy these things from you after you've approved them, and they've got a plan. When, if ever, are you going to start getting tempted to just figure out a way to hang on to these things?
Well, the thing is,
Good question. Is there a game? Is there a game in that where you're paying down the loan, owning more of the asset, and just like a regular real estate?
no, they got like I mentioned, this one investor, he's about to purchase an asset that has been owned by the current owners for 40 years, right? So there are people who buy assets and hold on to them for a very long time. For me, right, where I'm looking to build my business is I'm going to vertically integrate it. I'm going to create a property management company, and then eventually I'll set up a construction company so that I'm doing everything in-house, right? And I'm going to basically target one particular region and just do everything that I need to do in that region. And that's what I'm seeing with a lot of people. They're like owning the area.
Whether it's to turn it over or hang on to it.
Yeah, because guess what? The tax law says that if I take that 27.5, right, and I accelerate that to 5 or 10, right, I have all of these paper losses that I've generated, right? I can do a 1031, go into another asset, right? And I just keep moving that money around. That's why I call the strategy swap until you drop, because if you die and you have a tax consequence, your estate basically takes over your assets at an adjusted cost basis. So now you're leaving your estate and your inheritance to the next flock of people who come in behind you, right? So I call it swap until you drop, and that's how it was introduced to me several years ago.
Yep. And then, sorry to keep peppering you with questions. Why are you going down to the Carolinas if you live in Loudoun? What about Richmond?
Well, Richmond has a higher cap rate, so you're still, Richmond is not very different than Washington, D.C. in the fact that you're going to be probably, if you're getting $200,000 a door in D.C., you're probably going to get $160,000, $150,000 in Richmond, right? So it's just too frothy right now to be able to go in and purchase that asset at that price. But there are also, I've been looking at Richmond. There's some casinos that they're building in Richmond, and I think it's Portsmouth or some places like that, where that's going to be a magnet for bringing in jobs, right? Which means that when there's jobs, there's going to be a need for workforce housing. So I haven't said no to Richmond. That's why I'm going to go down there, build out relationships with the different brokers down there, property management companies, so that as we incubate the business, we can probably focus on that area.
And this was off market, so finding the deals is a job of its own, a relationship building business.
That's one of the things that I had mentioned. When you are in an area and people know that you can transact, they come to you with deals or where there's problem deals. So they come and find you and say, hey, we had a deal that went sideways. Can you guys get to the closing table? Right? So brokers do that. They have a lot of pocket listings, right? They'll come to you and say, because brokers don't get paid. You guys know that. Brokers don't get paid until there's a closing, right? So if a broker has a deal and you have transacted and closed with them before, they're much more likely to come your way and say, hey, can you take on this one as well? And because it hasn't hit the market, there's no competition. You know, it's a gentlewoman's agreement to, hey, this is how much we believe the asset is worth based upon the net operating income. Can you make it happen? And then you go and do the deal.
Got it.
Yeah, I relate to Nick's earlier question, Lee, about where do you find the time? Well, I guess
No, you make the time. You compartmentalize your day. You gotta, you know, be very prescriptive about who gets on your calendar and when,
no doubt.
right? So my wife is my business partner here. If I don't know you, she'll take the call. If we know you, I'll take the call, right? So, you know, the first time when we did this on the GP side, I think we had something like 23 investors. And now, because of the track record and things of that sort, we're up to just north of 50. And I expect that my database will probably be 100 in 2 years. And then, you know, whenever I'm not doing a deal, right, I'm going to be working with other operators who I trust, and I'll bring my investors to those deals just the same. But the one bit of confidence that I can give people is that I'm an investor first, right? So I know how to do the due diligence. I know what good looks like. And people who are professionals, they're working on their career, they're doing whatever they want to do. They want to put some capital to work in real estate, right? And I can be that vehicle that they use in order to get there.
What number GP deal are you at? Are you on deal 4 now as the GP?
Yes.
Okay. Mhm.
No, this is the 506B. So even if everybody on this call wanted to invest in it today, if I don't have a previous relationship with you, I can't let you in. But guess what? We're already there. We have raised our capital. Right now, we're just waiting for all of the legal to be done, and we're all set for the 29th to close. So, you know, we're not going to be doing another deal this year. So if you guys were to go to my website and I call it Club VIP, and you were to subscribe to my newsletter, we don't spam you. We probably send about 1 or 2, maybe 3 emails a month, letting you know what's going on. We have a newsletter that we send out at the beginning of the month, and then during the middle of the month, we send out a blog, right? So, and then we let you guys know when we have additional deals that are coming. So Meta, she says that she has some capital that she wanted to put to work. You know, let's build a relationship, and if it works for you, it works for you. I hope it works for you because it works for me.
Very
Thank you. That sounds good. I'll be reaching out.
Awesome.
When are you going to quit your tech job?
I love tech.
Oh,
I love tech. So my plan, I'm giving you all of my goodies, right? My plan is I'm going to set up a consulting shop where I focused on early stage innovation, right? Because I really love tech, right? And if I can, you know, harness that innovation and be able to put it into a solution that solves a business problem, I think I can make a tremendous amount of money doing that. And since it's something that I love to do, I don't consider it work. How did I meet my primary business partner? She's way smarter than me, right? She's way smarter than me. She has an undergrad from Harvard. She has an economics and a mathematics degree from Harvard. She also have her MBA from Harvard just the same. And she worked in all of the, you know, high-end consultant, McKinsey, Bain, BCG. And that life just didn't work for her anymore. Then she went over to corporate. She worked at Disney and other places. And we met through a colleague, a mutual colleague, and we met and we just kicked it off. And that's why I say this multifamily game is a team sport, right? You can try and take down a lot of deals for yourself. I just believe that stunts your growth just a little bit when you can find partners who you can team up with. your growth goes off exponentially. Wow, we went a long time.
Yeah.
I told you we didn't want to do slide, whereas we would just, chop it up, have questions, answer questions. But this is a model that basically works for everything, right? Donald Trump, love him or hate him, he's mastered this model, right? You raise capital, you move it into an asset, and if you can perform and make people money, they come back a second and third time. They come back for a lifetime, just to be perfectly honest with you. Bernie Madoff was that kind of dude, right? We don't want to go down his route because he was unscrupulous. But if you can show people how you can make them money and you can be consistent with it, they'll continue to come back.
Very interesting. Does anyone else?
That's a really bad, that's
I
good.
will be
Lee, but
going
you
to
probably want to use a
Joe
different example moving forward.
Sorry?
You probably want to use a different example moving forward other than Bernie Madoff.
Yeah.
Maybe like Warren Buffett or one of the other ones, like a paradigm.
Yeah.
I like your first examples.
Hey, look at right here. Where's the book? I'm a big Warren Buffett fan.
No, I'm just saying that I don't care either way. I just think it's a tough example to say, look how Bernie Madoff made money for his people. I don't know.
Well, I'm sure there was a time when he was doing it.
Well, yeah, he was the president of NASDAQ. I don't know if you saw his there was actually a show on his life on ABC, and they showed that there was just a lot of money in, and so people always got their returns.
I can't find it. Oh, I know where it is.
So Carlos and Nick, are you guys going to be investing in the syndicate? Do you guys have what it takes? Can you guys let go of control and put it in with Lee or what?
Yeah, I think I could, and part of it.
This book.
The other part would be the education.
This is the book that basically taught Warren Buffett how to trade, and it's called Security Analysis.
Oh yeah.
I think his name is Benjamin Graham, and this book is super thick, right? But this is the best book that's out there if you want to know how to trade securities. This book, and there's another book that I have over here somewhere, but it's called Trading for a Living. It's over here somewhere. But the book is called Trading for a Living, and it talks about how you have to preserve your capital. And if you don't treat your capital like your biggest asset, you're running into trouble. So there's plenty of books out there that teach
I like the diversification aspect, and I do think I think it's good, and it's not a short-term relationship. It sounds like a long-term, unless you want to get your gains. So it's a little bit of a 50-50. But this is exciting because you could get a little piece of something big. I know you like the numbers, Lee, but I like owning something like tangible. I'm sure you like it, but you were selling the numbers hard. But I also sell brick structures that will be here for a very, very long time.
No, you remember I said on the individual side, right? Let's just say you were to pick up a 16 or 20 unit in DC proper. You own that all yourself, right? DC is not going anywhere. The demand for rentals will always be there. You might have to deal with that crazy thing called TOPA, whatever it is. But if you hold that thing for 5 or 10 years, automatically it's going to increase in value just because it's there, right? You can take that and do a 1031 exchange. All of it is yours, right? You roll it into purchase another asset like kind, a similar price but higher. You 1031 it. And then at the 6 months or a year, you refinance it, take money out, you live in tax-free. And if you put that strategy together, that's why they call it swap until you drop. You can keep doing it. You move out of DC, you go and buy something in Maryland or Virginia, and you own that market, you're sitting pretty good.
So crowdsourcing, syndication, is this becoming more popular?
Oh yeah.
Or and people are becoming more open to it? Do you think it's social media that's getting the word out there? Because this has probably been around for a long time. Now the barrier of entry is going lower because you're able to chunk size it, part of the deals, and make it streamline. All you need to do is be a qualified investor, have $200,000 in joint salary or $1 million in assets. So that's so maybe the two.
I would say it's a combination. Realty shares is where I first got my first PPM that I read, realty shares, right? But you guys now know realty shares is defunct. They're no longer there, right? But I would say the democratization of, multifamily and commercial real estate happened with realty shares. There's Realty Mogul, there's Fundrise, there's CrowdStreet. All of these platforms have democratized access to these investments, where before you had to know someone who was in this business.
Are you
right?
nose to nose sometimes with hedge funds that are trying to scoop up these assets too? Like,
Well, the hedge
are the
funds
normal
playing
people
at a higher level? So, like for
like
instance,
a very higher level?
my friend, he works at CoStar, and he can run a report for me. And there are transactions happening in the DMV. It's just that they're usually starting at 50 to 100 million. Right? There was something that went down in Fairfax the other day. I think it was almost a 300 to 400 unit complex. It traded for 216 million. Right? So that's where the institutional guys, they're coming to the table and saying, well, we have 20 million, $30 million that we need to put to work, and we need to put it to work in some place that's safe. They'll come with $20 million and give it to you to put into an asset to put it to work. But remember, the institutional guys, they're probably looking for 4 or 5%. So a cap rate that's DC, they can get along with that.
If I heard those numbers right, that was like 400,000 a door.
Oh, way more than $400,000 a door, maybe $500,000 a door, but they're bringing institutional money, they're bringing insurance capital also to work, right? So the insurance company only needs 3 and 4% return on the money.
Got it.
Right?
Guys are looking for bonds, not.
Yeah. But they're looking for something that might have a little bit of a premium to the bond.
Yep.
Because then that's where the risk becomes a play, right? So they're looking for something that's going to perform just a little bit better. And if they can get it, multifamily, real estate, commercial, all of those things do very well in that space. But you're talking about a totally different game. I want to get there. I'm not there yet. But that's when you're going with, so you mentioned accredited and all of the terms that come with that. You have a qualified client, right, who has to have a net worth of 2.5 million, and then you have a qualified participant, and they have to have, I think it's like 5 million. So when you start working in that space, then you can start working with a family office and, very wealthy people who basically invest their own money when you have a family office. So there's many different layers to this, right? And as you become exposed to it, you can get yourself involved in it just the same.
I mean, the one thing I can take away, Lee, is that something that you said is really smart, is that invest in jobs. When I used to work with a hedge fund it was a guy who managed over 20 million, 25, he had like a proof of funds statement. And whenever we'd go to look at properties to invest in, I would take it to the bank that would put down, like he would put down the down payment in the bank. And they're like, Jad, there's no jobs here. Because my job was to try to find high rates of returns. So it would be like Roanoke, Cleveland, and I can get like 13% cap rates,
Yeah.
And they were just like, yeah, but like, there's no jobs here. And I'm like, it's a 13% cap rate. And then they're like,
get what you pay for. You always get what you pay for. In America, there's still no free lunch.
Like Hagerstown, I mean, maybe that's growing, but that's a depressing area. Dayton, Ohio, depressing area. I mean, if you're on LoopNet, if you're on some of the other like brokerage, you'll see high-end stuff. It's funny, back in 2016, North Carolina was very cheap. It's blown up recently, but you can get huge portfolios in Wilmington. Oh, do you finance, or Lee, do you do syndicates for portfolios of homes?
I'm not in that space. I got another guy. His name is Sam. He's purchasing portfolios in and around Baltimore County. So like he just did 18 property purchase up there. And I think he was under contract for another 24. So, you know, he's buying those duplexes as a portfolio and he's making it work for him. But I wouldn't be able to help you in that space.
I was going to ask you a different question, but because you mentioned Baltimore, I just want to ask this now about Baltimore. Do you view Baltimore as a Class B MSA?
I would say Baltimore is probably, well, in Baltimore, I'm sure that you have Class A locations, right? But, you know, you look at a whole entire MSA, and inside of that MSA, there are going to be certain submarkets that would be attractive, whereas others wouldn't be.
So can you find yourself, like what you described you want before, a Class B location and a Class C property that you can upgrade in Baltimore?
You can do it, but one of the things that I look for is I look for states that are more landlord friendly than tenant friendly.
Okay.
Texas is all about landlords.
And also, Carlos, about your thing in Baltimore, I think it's 51% of the property owned in Baltimore is owned by investors. So think about that, Carlos. There's not really a lot of private ownership. If there wasn't Section 8, Baltimore would collapse overnight.
Well, then you have
Who
Baltimore
would
County.
invest there? No one.
There's some good places like by that racetrack. There's some good places over there. When I was looking at purchasing, I think it was a 16 unit. I had underwritten a deal there, but you know, we didn't come in high enough.
I brokered a 62 unit transaction in Baltimore for 4.25 million. The guy was asking like 4.7. I got it off of LoopNet. I got it for my client. He's happy with it, but he's stuck paying the water. Taxes are crazy. He has a property manager. But when you pay for something all cash, you really don't have to worry about if your tenants don't pay because there's no mortgage on anything, you know, except for the property taxes.
Yeah. No, and that's what you're running into. When you go into that small multifamily space, you're typically going to be competing with doctors, attorneys, and people like that who don't really have to turn it around and bring in investors and things of that sort. So they can go for something that has a low cap rate versus a higher cap rate, etc. So there's many different ways that you can do this, right?
Can I ask, should I ask you, well, I don't know, you've been very generous with your time, first of all, so we're way over and you may need to get going. But I would like at some point to run through a scenario with you so that you could help me think through the reasons why to deviate from my MO.
Yeah.
You know, and with like, you know, $200,000 as the amount of money. Generally, I'm always looking to pull together $200,000, roughly. The reason that I focus on that is I like to put 20% down. I like to buy $1 million properties.
Yeah.
Lazy man. Just let the 3% mortgage do a lot of the work for you. Hopefully you get some appreciation on rents, cash flow, positive, negative. Obviously I want positive, not a big deal. But now I'm getting older. So 30-year tables are you're gonna put me on. I better keep up, you know.
So I totally get it. And I would say you can probably still continue with that strategy and diversify a little bit of capital to work over here just the same.
Yep.
Right. So, you know, right now, commercial, office space, medical, right, with the work from home situation, those properties are probably going to be trading at a discount pretty soon. Right. If you look, WeWork just did their first quarterly report and they made money, but they still lost $802 million. Right. So I think that there will be a place in a new work scenario. I just believe that it's going to be slightly different. So you would have to find where that value is going to be, right? And then you take advantage of that. So on my website, there's a calendar there. You could schedule some time. We'll talk.
But Lee, I think what Carlos is asking is like, I have $200,000. Normally Carlos would just put it into a small buy and hold. Him and his wife will walk by it, make sure that everyone's paying. He's saying to himself, Lee, why should I not put my 200,000 into some crappy row house in Colombia that's Carlos is going to make a ton of money, like not a ton of money, but a small cap rate? Why should he put the 200,000 with you? Can you walk him through a scenario with how much money would he make on his $200,000 per year, let's say over a 36-month span, if he was to give you his $200,000?
You know what the problem, the issue is that I have taken always a very long view, but
Yeah.
I'm starting to be interested in shortening it because I'm getting older and I've got.
Oh, come on, Carlos, you're still a young man, please.
What's that?
Well, I would
Empty
say,
nester, man.
I would take that same $200,000 and I would put it into 4 different assets, so 50,000 per, right? And then I would have the diversification, although, right, I would have the diversification, but I'm still making that cash flow. Right now with syndications, there are different classes that you can get into. You can get into a syndication that will offer you a 9.5% preferred return, but you're not going to be able to participate on the back end. Or you can get into another class whereby you'll get 8% preferred return, but then you'll be able to participate in the back end, right? So, you know, you're not really comparing.
How much, and Lee, so Lee, like your unit in Houston that you're hopefully going to purchase. So what would Carlos's return be? So he has a $200,000, he'll get 8% hopefully on an annualized basis. So that's about $16,000. And then when you go to exit the building, he would get what then?
Remember, we're forecasting on this one that the return over the entire project would be 128%.
Wow.
That's why you can't compare that scenario to this scenario, because it's like comparing an apple to a walnut.
How many years, Lee? Lee, how many years would that take?
5 years.
5 years. That's incredible. See, Carlos, what are you waiting on? Get in the game, Carlos.
Sounds really good.
All right.
So
I
that
think I've answered all.
456. So my 200 would be 456, I guess, right?
Mm-hmm.
Uh-huh.
Well, thank you so much, Lee. Really appreciate it. We're definitely going to have you back to see how everything is going. If not with the grid network, you know, just maybe you know, a few of us. So thank you so much for spending time. You came highly recommended with from Rob Chavez, and you definitely over delivered. You know, communication with me has been flawless. Spoke with your associate today.
That's my wife.
She was very nice. Huh?
That's my wife, Bill. Husband and wife.
Oh, she's so great.
No,
She's so
that's
great.
my wife. I love her to death.
Yeah, look forward to you know, hearing the stories and you know, seeing what you're going to do. I now subscribe. I'm now in your database. If you want to put your email down, you know, go ahead. We could share some emails if you wanted to be put on his database. But
just go to my website. There's 4 fields that you have to fill: your name, your email address, when you're looking to invest, right? And you're in the database. That's one way to get onto my calendar, because I have a nice CRM and it'll schedule some time for me to talk to you. Or if you're pressing right at the bottom of that, you could also schedule a calendar just the same. And this is what I do, right? I love talking to people, opening up their minds to some of this, you know, where I come from in Jersey City, New Jersey, very humble beginnings, but you know, I was able to get lucky, and I consider myself to be very lucky, and I'm happy to educate others on my journey and help them to achieve the same status that I have now.
Awesome, man.
awesome.
You have a great place.
A few other things. The 21st, we're going to have some success stories. So stay tuned for that. 2 grid investors hopefully will be joining us about the properties they've bought and the money that they're making. Find and renovate fixer-uppers, January, 1031 exchange in February, and Section 8 with Dr. Joe in March. So tune into those topics, and thanks again. Thanks, everyone. Have a great evening.
You're an inspiration, my friend. Thank you
I'm
very
more
much for your
inspired by
time.
you. I got to put some money to work with you one of these days.
I'm excited. I'm a little bit greedy. I don't like to share, but we'll talk later.
All right, guys. Have a good
All right,
evening.
thanks,
See y'all.
guys.
Thank you.
Thanks, Franklin.